what happened last time we had high inflation and weak labor markets? What was the stagflation play? And it was oil and gold. And oil is in a different market right now. We don't have OPEC cutting oil supply. We have OPEC ramping up oil supply. So that leaves gold as the most obvious go-to space here. Maybe it doesn't look like it today, but going forward, the louder that stagflation drumbeat gets, the better that is for gold. And that's a scary thing for me to say at $3,700 gold, but that's the way it looks to me.
So in general, it's positive. It's positive as long as there's not associated fear. So for instance, during the Liberation Day period, when the dollar was declining, there was fear in the markets because of what was causing it, and the markets fell. As long as it's a slow grind lower, investors are happy with it. Gold generally will go up, Bitcoin generally will go up, risk assets will go up. But if you get in a situation where people start panicking over the dollar decline, then forget about it. Stocks literally could crash.
The current landscape for gold is being shaped by forces that extend far beyond short-term price swings or algorithm-driven trades. Inflation pressures remain embedded, labor markets are showing cracks, and the global economy is adjusting to a more fragmented and less efficient trade system. While knee-jerk reactions often dominate headlines, they rarely reflect the underlying trends that drive long-term value. In times of stagflationary signals, history has shown that hard assets stand out, and this cycle appears to be no different. The difference now is that central banks are actively buying, placing a firm floor beneath gold prices in a way not seen in previous decades. Lobo Tiggre, a seasoned investor and publisher of the Independent Speculator, emphasizes that central bank buying has fundamentally altered the market structure, providing resilience even at elevated levels. GarethSoloway, a veteran trader and technical analyst, adds that while volatility and corrections are inevitable, the macro picture still points toward higher gold prices over time. Both voices emphasize that fiscal dominance, policy uncertainty, and the restructuring of global trade all contribute to the same outcome: increased support for tangible assets, such as gold. Taken together, their perspectives highlight that gold is no longer just a hedge against inflation, but also against systemic instability. Corrections may come, but the trajectory remains higher as institutions and individuals seek safety outside of fiat. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. And enjoy the video.
First, looking at the market gyration, that's almost never a good or a clear signal. I mean, it's important, it's relevant, you need to think about it. But the immediate knee-jerk reaction is almost always wrong. And the thing to remember is that those knee-jerk reactions at the beginning, that's not you or me or the average gold bug calling up their stockbroker and saying, "Hey, sell my gold stocks. I've changed my mind." Or that's not the mom and pop bullion buyer running down to the local coin shop and buying or selling a few more ounces. This is traders trading with their algorithmically programmed machines. And they've got triggers. Oh, if this happens, then sell, or if this happens, then buy. And then afterwards you say, well, wait a minute, that happened, but not for the reasons we thought. So reverse course. So it's very dangerous to put too much weight on the initial market reactions here. They're not human reactions. They're algo reactions. And the algos are often, programmed wrong. So that would be the first caveat here. In terms of the gold market going forward, even before we talk about Fed policy and fiscal dominance and all this stuff, remember the central bank gold buying. That really has been a game changer. It is clearly put a much higher floor under gold. It's not done yet. Maybe someday, years down the road, central banks will stop buying gold. Maybe they won't. Maybe they'll continue moving that way for beyond our investment time horizons. But right now, that's really important because it's not like it was the last time around. So that's one thing. And that makes me less nervous about being a gold bull, even above previous all-time highs. The other thing is, don't forget the fiscal dominance. So, generally speaking, lower rates should be good for gold because gold doesn't pay interest, right? Though there is an alternative for that right now. But anyway, there's an app for that. So if the signal we got today is that the Fed is going to err on the side of protecting the labor market and cutting rates, that's actually bullish for gold. And never mind what the algos did today, that on itself historically has been bullish for gold. Now, if the inflation side comes back, and comes back, stronger, and the market decides, oh, well, the Fed said they were going to take care of the labor market, but they're actually more interested in inflation. This is not what's happening now. But if that did happen, ironically, that would be the knee jerk would be negative for gold, because gold doesn't pay interest, and higher, rate increases are supposed to be bad for gold. If that happens, I think that would create a fantastic buying opportunity, because at the end of the day, inflation is inflation. And anything real, anything that governments can't print, goes up as the printing continues. So basically, never say never. But if I'm going to look at it theoretically or logically, or I'm looking at the charts, or I'm looking at the macro situation, all these roads point towards higher gold going forward. That having been said, and gold bugs get mad at me, or silver bulls or uranium bulls, whenever I talk about, you get a hockey stick chart, it's not unreasonable to expect some measure of correction. And that's entirely possible, Kai. Anybody who tells you, no, it's impossible, gold has to go to the moon next, they're selling something. I wouldn't trust them. And I do think this was one of the moments when the market turned today, because if he had just said it's a one-time effect and left it at that, then everybody would have said, oh, so he's not worried about inflation. He is more worried about the labor market. So more cuts are coming. Woohoo, yay, Glover's gone. But that's not what he said. He brought it up to say, but there's reason to think it may not be so transitory, though he didn't use that word. And that's when I saw the market turning today. That's one of the things that I think was not baked in and did surprise people. As far as, where he could get the message from or whatever, I mean, just look at the ongoing negotiations with China. We keep being told we have a deal, but then, something changes. Just lately we've got China telling its domestic producers to not use any NVIDIA chips, basically banning NVIDIA chips, which is a strong hit to NVIDIA, which is a big, one of the big pillars of the market rally we have now. And so this is, maybe it's just a negotiating tool. Maybe, actually, I think it probably is. But it's really interesting because it reminds us, people were saying, oh, it's all about the rare earths. We got to make, China, it turns out, the famous with Trump and Zelensky, you don't have any cards. Well, she does have a lot of cards. The rare earth card turned out to be, if you'll pardon the expression, quite a Trump card. It was really powerful. And it caused the U.S. side to fall back and renegotiate. Well, whacking NVIDIA really hard, that's another high card, if not a Trump card. That's a powerful card. So if you're sitting here trying to make monetary policy and you're looking at how the whole tariff trade war is unrolling, it's not one and done. Liberation Day was not maximum stress, it turns out. It's an ongoing stress. And, you have to rethink your outlook in terms of one and done. And then don't forget, even if there is a deal, well, A, those consequences need to work their way into the real economy. And then B, what about the ones where there isn't a deal? And what if there's a retaliation and all that stuff? We still don't know where that's going to go. But at the end of the day, let's say 6 months from now, we have all the answers. Yay, all the answers, right? All the tariffs are settled. Oh, and by the way, for that to really be settled, we probably need the Ukraine war to be over so that the punitive tariffs, never mind the reciprocal, but the punitive tariffs for Russia cooperators or collaborators, all that's gone, right? We have a new stable regime for tariffs. We know what that is now. Well, that gives you room to say, okay, now that's one and done. That's behind us. Now, we had these price increases, but they're done, so the rate of change is back down again. Well, yes and no. What if all of that makes the whole world less efficient? Like we had this massive globalization for decades, and what if the new tariff regime that's already started to undo that? What if it goes further? And what are the not just one time, but ongoing effects of a less efficient global economy? So I think there's arguments to be made for it's not just the tariffs now, but it's the transformation of the global economy where everybody wants to become more self-sufficient, not just Trump in the United States. And there is an ongoing cost to be paid for that. That inefficiency of duplication of supply chains and production bases in multiple countries makes the entire global economy less efficient, that's more expensive. And as an Austrian economist, I want to say that all inflation is, always and everywhere a monetary phenomenon, but it works its way into the real economy and it's expressed in and policy responds to higher prices, consumer prices in particular. So there's an argument to be made for, ongoing increases in consumer prices. anyway. And that's bullish for gold. If we want to tie it back to that, I think it's actually bullish for everything. Again, I like to say everything real. And of course, I like JP Morgan's definition of gold is real money. Everything else is credit, right? So where do you want to go from there? But I think there is a case here. The politicians, none of them want to say it, but I think there's a case here for saying that it's not just the change in the tariffs now. That rate of change can go to zero, but the knock-on effects, have long-term consequences. And I do think they're inflationary. If gold goes up to 4,000, I stay long. But if gold rolls over and it corrects, my triggers will get pulled and I will be taking money off the table. So I won't get hurt.
The market's reaction to the latest Fed move highlights just how fragile sentiment has become. A 25 basis point cut was already priced in, but the tone around future policy was the real signal. The board is divided, with resistance even to 2 cuts this year, and that uncertainty weighed heavily on the Fed chair's delivery. His demeanor reflected the strain of political pressure, economic fragility, and the growing realization that tariffs are beginning to reintroduce inflationary forces while labor data weakens. That mix is textbook stagflation, a dynamic that markets are not well positioned to absorb. Price action revealed how sensitive everything has become to both the dollar and yields. The sharp intraday swings in the S&P, the dollar index, and the 10-year Treasury underscore how tightly correlated and algo-driven these moves are. Underneath the surface, though, the genuine concern is structural. Margin debt at all-time highs, retail speculation returning in meme assets, and hedge funds chasing performance are all classic markers of late-cycle excess. Overlay this with the erosion of Fed independence under political fire, and the longer-term implications for the dollar's reserve status become unavoidable. These are not normal market conditions. These are warning signs. Let's get back to the interview.
The 25 basis point cut everyone knew that was coming. That was no big surprise. The Fed Watch tool had priced it in over 90%. So anytime it's 90% plus, that's essentially as sure of a thing as we can get. But this is the kicker. He said that many members on the Fed board are against even 2 rate cuts in the remainder of the year. He said there was one Fed official that was for more than 2 rate cuts into year end. I think we can all surmise that might be the new Fed governor that Trump just appointed. But I thought it was very interesting. So number one, when I was watching his commentary, he seemed very defeated. He seemed very tired. I don't know if that's the stress from Trump or if that's the stress from just the job in general. It could be a combination, maybe even what's going on with Lisa Cook. But I did think that was interesting. And then he did admit that at this point, we're starting to see inflation pressures that are coming from tariffs. And we're also seeing a weakening labor market, which is stagflation. And I just want to show this because while the markets have basically gone back to where we were prior, there is absolutely a big move intraday. So what we saw here is initially when the Fed, this is, by the way, the 10-minute S&P chart, SPY chart, initially we popped. Then we had a huge sell-off, and now we're coming all the way back. And I want to just show you what the U.S. dollar did here. This is incredible. So the U.S. dollar intraday had a huge drop initially when the markets initially popped. Then as the dollar rallied back up, the markets started to sell off. And now that the dollar's coming back in, we're seeing the rally back in. So we're really seeing this inverse relationship again with the US dollar that has been very consistent. This is a lot of algo trading. I also think that the markets have rallied back because there's still this buy the dip mentality. Investors, and again, we have lots of feelers out there with people commenting on videos, but there was this general consensus among retailers that a Fed rate cut would be really good for the stock market as well. And so they're getting that, and there's more money flowing in. And then lastly, we got to take a look at the 10-year yield. The 10-year yield, holy cow, initially dropped to 3.99%, then shot up to 4.08% and is now pulling back. But again, even with the Fed rate cut, we're not seeing the 10-year yield really drop at this point significantly. So there, yes, we're seeing the markets kind of flatten out to where they were prior, but I would argue that the underpinnings of what's going on is very, very interesting, both with Jerome Powell's commentary and with the market reaction. And this is what happens every bull market at the very end, is that you have a disconnect, right? And you could even say this disconnect is with gold. Gold and the S&P very rarely continue to make new all-time highs together for as long as we've seen recently. And that tells you something. Both of those will not continue to make new all-time highs. But going to this other factor is, you're right, past bull markets, just before they end, the data starts to weaken. but there's still this FOMO, this fear of missing out amongst retail investors. And what I look for in the data that tells me and puts me on alert is margin levels, right? We're now at all-time highs on margin, which is people borrowing money to get into the market. All right, we now have people investing in meme craze again. We've seen stocks that are now saying, oh, we bought some Chainlink or we bought some Ethereum, and they go up 3,000% in a day. These are the same things that occur in every cycle. And it's a human psychology trait to where you feel like you're missing out. And at that point, you have to play catch up. And by the way, hedge funds find this the hard way too. If into the end of the quarter, they are not performing like the rest or as the market is, they have to just force money. They force money into the market and they try to play catch up. And so this is something that is a human psychology trait, but it's also an indicator of market tops. And so again, whether we're topping today or whether it's a week or a month away, that's hard to predict. And I'm not a great predictor of that. But what I do know, and I've been through 99, 2000, 2007, through COVID, all of these signals occurred just before, even in 2021, we saw the same thing with Bitcoin, with crypto, and with memes like GameStop and AMC. And so, again, it's more of a breadcrumbs where it's dropping these breadcrumbs, and then it's up to us as investors to start pulling the reins back and being a little bit more cautious. This is the kicker, right, is that we're already seeing the erosion of their independence. And again, it's a slow virus that is eating away, or a bacteria that's eating away at the Federal Reserve. But anytime you have President of the United States, arguably the most powerful man in the world, attacking the Federal Reserve so openly on social media, it's going to make other countries think twice, right? So, that's one of the things is we are very reliant as a country on other countries buying our debt, right? We need them to finance our expenditures, which now are massive. In fact, 1 trillion just in interest payments per year. And so this is only going to make interest rates on the long end of the curve go up. Now, listen, the Fed can keep the short end controlled because that's what they control, but they can't control the long end. And ultimately, that is going to be the issue. I want to show you something here on my charts that really has me concerned. So we're going to look at the DXY. The DXY on this chart has shown us that it has broken major support that goes back to 2022. So with the dollar here, and this is so concerning to me, is that the dollar was holding above this 101.5 to about 100 level on the Dixie for multiple years. Recently, as we saw the attacks on Jerome Powell start to take hold and the Liberation Day tariffs begin to take hold, the dollar broke that support, tried to get back above here, failed, tried again, and is now breaking to the downside. We're getting a bounce today on the back of the Federal Reserve commentary. But this is the issue, is that the dollar is now attacking a support zone that goes back to the lows of 2008, a trend line or trend line zone that goes back to 2008. Now, mind you, this is important because this was when the financial crisis began. The dollar began to gain relative strength against a basket of currencies. If you break this zone, basically anywhere between 96 to 94 on the Dixie, the DXY, you likely are headed back to the 70s, basically 71 on the DXY. And you can't blame other countries, right? Other countries are looking at the US dollar as their reserve currency, and they are beholden to the US. They basically have to bow to the US in many situations. And so it's now between tariffs and what the president has done, it's starting to make these other countries say, wait a minute, do we want to let the US have this much control over us? Or do we need to diversify away from dollars and buying US debt so that we are not so beholden to any of their whims? And that's what's happening. Absolutely. Poland recently said 30% of their reserves would be gold now. We've seen Bitcoin starting to peek into reserves of countries. Countries are now selling dollars and reducing their exposure. Now, listen, the dollar, we're not going to see the dollar collapse. Reserve currencies historically don't just collapse out of thin air. But is it the beginning of a longer trend now of the dollar slowly losing that reserve status? I do believe it is. And if we break 96 to 94 on the Dixie, the DXY, that is the catalyst to further downside and significant downside. So in general, it's positive as long as there's not associated fear. So for instance, during the Liberation Day period when the dollar was declining, there was fear in the markets because of what was causing it, and the markets fell. As long as it's a slow grind lower, investors are happy with it. Gold generally will go up, Bitcoin generally will go up, risk assets will go up. But if you get in a situation where people start panicking over the dollar decline, then forget about it. Stocks literally could crash. I wish there was something that was independent of the Fed. So as of now, not really. I'm certainly not buying gold up here. I will buy on pullbacks if we get a good, strong pullback. Silver, I continue to like, but same thing. It's just had too much of a run. But again, essentially, if you're looking at years out, metals, eventually Bitcoin, once it pulls back, I want to really start loading up again on that.
We're entering a phase where signals of late cycle excess are everywhere, yet markets remain complacent. When both equities and gold push toward record levels simultaneously, it's a rare alignment that doesn't last indefinitely. Add in record margin debt, speculative bursts in crypto and meme assets, and the pressure on the Fed from both politics and the economy, and what we see is not stability, but fragility disguised as strength. History shows that markets often look their strongest just before cracks become undeniable. The danger is not in missing the final upside push, but in ignoring the clear indicators that risk is growing faster than opportunity. This is a time to step back, reassess, and think about how capital preservation fits alongside growth strategies. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. Thanks for watching.